Hello, how are you? It's me, Moses, again today. So I want to discuss with you today the non-current assets, which are going to lead us to depreciation. Okay, our main goal in this series of tutorials is to discuss the depreciation. Okay, so for non-current assets, we have an idea, I'm sure. We spoke about this several times, so we are saying this is an asset acquired and retained in the business with a view to earning profits. Okay. A non-current assets will be acquired and it will be retained in the business for more than one accounting year, and it will be earning profits for the business. The other important component I want to talk about is the materiality. This measures the materiality of the assets that you have. Some of the assets may be too small to be accounted for. So materiality would define either those small assets should be accounted for. For example, a box of pencils, a paper basket, a broom, and so many other small assets. So depending on the value that those small assets, when put together, that they are making, they will be regarded as an asset. That's what materiality is all about. So something that is material to a small organization may not be material to a large one. Okay, it depends on how big the organization is. Some organizations may regard, let's say, chairs as assets. Small stools. Some organizations may regard them as assets, and big organizations may not regard those small stools as assets. That's what materiality helps us to look at. The other item I want to talk about is self-constructed assets. Self-constructed assets. These are assets whereby you have a project, you're building a big building, and then self-constructed assets comes in, whereby maybe the builder builds their own office within the premise. So the treatment of such self-constructed assets is that you add their cost together with the main cost for the building. Okay, that's what we need to know. That's how accounting treats these things. The other part is the acquisition of non-current assets. Acquisition of non-current assets. We are talking about acquiring, okay? So when you buy non-current assets, there are three ways you can buy, either by check, and the double entry is going to be debit non-current assets, and then credit, of course, the bank. Okay, credit the bank, maybe by loan. You acquire a non-current asset by loan. Double entry is going to be debit non-current assets. debit non-current asset, and then you're going to credit the loan payable. Okay. Either the other way is by finance lease. Finance lease. Lease is whereby you acquire a property on lease. You agree on a number of years you're going to use that property, meaning you've acquired it for that period. Whereas the person who's the original owner still owns that property, but because it's on lease, you also own it for that particular agreement. Okay, so if you acquire on lease, finance lease, you debit till your non-current assets. The double entry is just the same. I'm sure you have an idea. And then credit lease payable. Double entry, I'm sure, is simple by now. Okay, so I'm just quickly trying to explain the notes that I have, so that even if when I send the PDF notes, I'm sure they will make more sense and add more meaning to you. Okay, now we continue to the main component that I want us to look at, which is depreciation. Depreciation, okay. So depreciation basically talks about a non-current asset. A non-current asset, okay. A non-current asset. So we're talking about a non-current asset. It has a cost. The cost that you buy this, let's say you buy this at 4,000 kwacha. The cost, and then this has the useful life. Okay, useful life, this is a period of how long you expect to use this non-current assets. The period of how long you expect to use this non-current assets, that's let's say you expect to use this for 4 years. Okay, that's a useful life. Let's say 4 years. 4 years. Okay, 4 years. Then you expect this non-current asset to decline, as in to diminish. I mean, as in to be used. The business will no longer need this non-current asset. You estimate to say by this number of years, I'm sure it will be done in value. It won't have value. Okay, so that's the useful life. And then we also have the residue value. Residue value, I don't know the spelling, maybe I've made a mistake. The residue value, this is the scrap value, same as scrap value. Scrap value, okay. Scrap value, let's say at the end of the useful life of this non-current asset, maybe it will have a certain value. It won't be out of value completely. So let's say from 4,000, the original cost, maybe you estimate, say, to have a residue value of 500 kwacha. That's the value at the end of the useful life of this non-current assets. Okay, so I've already started explaining depreciation. From this, you will understand what depreciation really means. Okay, so let's say so this is a quick example about depreciation. I'll give a typical example about the methods of depreciation so that you understand fully, but this is a concept to start with. So let's say depreciation per year, you estimate this your non-current assets, it will be declining in value by 1,000 kwacha. And then its useful life, okay, let's not calculate first of all, let's ignore this amount. Let's just calculate the depreciation from the 4,000 cost that we have, and then we expect to use this non-current asset for 4 years, and then what's going to be the depreciation value. So 4 into 4,000, you discover that this will give us 1,000 kwacha. So every year, this your non-current asset, it can be a building, it can be a motor van, it will be declining in value by 1,000 kwacha. So by the end of 4 years, the whole cost of the non-current asset will diminish. It means the non-current assets won't have value in the books of accounts. So let's define depreciation. Depreciation is a way of charging or spreading the cost of a non-current asset by the business in the statement of profit or loss following the cost of a non-current asset over its usage period less the scrap or residue value. Okay, let me explain this. Maybe it's not making too much sense. Let me just quickly explain. So depreciation is just a way we spread the cost of a non-current asset. You've bought a non-current asset and then it's been used in the business. So it's helping you make those profits. So for you to estimate the correct profit, you must put the value of that non-current asset in your profit or loss statement. Okay? For you to find the more definite profit. So depreciation appears on the expenses, non-cash expense. You didn't spend any cash, but you assume it's an expense which is also helping you make profit. You are spreading the costs of that non-current asset that you use in your business, in your trading, so that you calculate the profit. Okay, I'll give you a more defined depreciation in the next tutorial, where I'll also do the calculations using the methods that we have and depreciation. But for now, the point you need to know is depreciation is a non-cash expense. Is the way of spreading or charging the cost of an asset in the books of accounts, in the profit, in the statement of profit or loss. So depreciation appears both in the statement of profit or loss and in the statement of financial position. In the statement of financial position, it's going to reduce the value of the non-current asset. Whilst in the statement of profit or loss, it's going to be a non-cash expense. It appears under expenses, so that you don't overestimate the profits that you calculate. You have to subtract, you have to spread the cost of that non-current asset, so that you calculate your profits. Hopefully my tutorial makes sense. Thank you so very much for your time. Look forward to my next tutorial, where I'm explaining depreciation in full. This tutorial is prepared for Success Knowledge Center. I appreciate your time. Thank you very much.